Okay, today we are going to be covering how to hedge your portfolio. This is one of the most important topics. Everybody always tells you, here's a really hot stock pick, buy this and it's going to go to the moon and you're going to be able to sit on the beach forever, right? But nobody says, hey, what happens when the market actually has a downturn and how do you protect your portfolio? And I think this is a conversation that we should be having more often, just because of the fact that we are now at all-time highs, right? So there are a couple of different methodologies on how to protect your portfolio. And I'm going to give you one that pertains specifically for retail traders. It's one that we implement for a couple of different reasons. Look, if you've got a massive portfolio across different sectors, then, doing it on an individual basis, on an equity basis, doesn't really make sense. In that instance, you go and buy a protective hedge against something like, the SPY or QQQs on the NASDAQ. But there's a fundamental disadvantage to that specifically for retail traders. And that disadvantage is that you don't actually own the underlying SPY or QQQ equity itself. Therefore, you are buying a protective put and it's literally money down the drain. You're literally buying it for thousands of dollars. Obviously, you're going to buy it out for a few months, right, from a protective put perspective. But there's no way that you can actually make money off that protective put that you've actually bought. There is a better way, and this is exactly what I'm going to show you today, is by buying a protective put on an underlying asset that you actually own, but then also selling covered calls against that specific asset. And there's a third trick that I want to show you that very few people are talking about as well. And for that, I'm going to jump into the wealth grid, which will actually give you all of this information. One of the reasons we found why people actually don't, talk about, hedging their portfolio, because it's complex, right? So in order to take out that complexity specifically for retail traders, we built a platform that actually shows you how to hedge, at which specific strikes, how much is actually going to cost you, what your deltas are going to be, and it's all built into our wealth grid platform. So let's jump in and let me show you how to hedge your stock portfolio like the professionals do. So here we are in the wealth grid, and the wealth grid was a platform that we actually built for us. We dividend investors, we also option traders, and it's a super simple application that kind of gives you the ability to actually track your portfolio and do a whole host of different other things, right? Option analysis, and today we're talking about the Hedge Hub. So I want to show you how this actually works, so you can hedge your portfolio like the professionals do, right? So let's jump in. So here we are in the Hedge Hub. And again, the strategy that we have here is to look at the equity that you actually have, right? So let's assume that you own some Amazon and you want to protect it on the downside, given the fact that the market is at the all-time high at the moment. So we're going to put in Amazon as the ticker, right? Obviously, you already own the shares because that's the shares that you're wanting to protect. Let's say you own 100 of these shares, right? And the current price on Amazon is, I think, $243, right? Now, the tool is so simple that that's all the information that you actually need to put into it. You'll then run the strategy, right? And the strategy is basically this. You're going to be buying a put 3 months out at a protective delta of roughly about 40, right? Makes it slightly cheaper for you, but also gives you the delta necessary to actually protect your shares. And then we're going to offset this cost by selling an actual covered call on the actual assets that you own at a 20 delta, right? And the tool will calculate this all for you. So you don't have to think about where do I actually need to put the strike? What do I actually need to do? Where does it go? How much is it going to cost me, etc., 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 right? So this is what it spits out. So if you're going to buy a standard put, right? That put is going to be 3 months out. It's going to cost you roughly about $17.25 per share, right? That's $1,725 essentially. And this is 3 months out, right? Then you're going to sell, and then you're going to sell it at a strike of 240. Then you're going to sell the weekly covered call at the strike of 250, and you're going to get a premium of $100 or $104 every single week, right? So you're using that $104 to offset the cost of this $1,725 that you paid for the protection. So essentially, you're buying protection, but you're buying it at a zero cost because you're actually making up that specific cost base and still protecting your shares all at the same time, right? Waiting for market appreciation. Okay, so it gives you the calculation and it says you're going to buy the long put, one contract at $1,725. and your projected weekly income for selling covered calls for the next 12 weeks is going to be roughly about 1,200. Yes, you've got a net loss here of roughly about $500, right? But imagine you didn't buy this, right? Then you would have been down, your position would have been down by either $1,200 or $2,400. And you can see that drawdown calculation happen for you right here. Now, again, we've made the tool so simple where you can actually see what your drawdowns are actually going to be if the stock pulls back 5% or if it pulls back by 10%, right? So look, if your stock is currently at 230 and your position loss on your actual stock that you have at a 5% drawdown is going to be 1,215, right? If the stock takes a 10% drawdown, you're looking at a $2,500 loss essentially. That's without hedging, right? But now let's think about this in a different context, because if it does draw down on these amounts, your net P&L is only going to move by $300, right? So putting on this protective hedge is not costing you thousands, like if you had to go and put on a hedge in SPY or QQQ for an underlying asset that you don't actually own, right? So that's the beauty of the system. We'll give you a little bit more information here with regards to how this hedge is actually working out and how it is calculated and all of the back-end mechanics for you. So you don't have to think about this, right? You just go and you execute essentially at the end of the day. You're a retail trader. You're here to make money. You know, there's a saying that, 90% of retail traders lose, right? We in that game to show retail traders that they can actually be profitable, and this is how to hedge their portfolio. So we also give you a quick explanation on how the covered call works to offset your costs, right? Now, if you are a more seasoned options trader, you can actually reduce this cost by even more, right? And we give you this option to show you how you could actually reduce your cost to almost zero and actually come out with a positive balance at the end of the day. So step 3, we're going to reduce your cost by selling not only a protective put, but by selling a vertical, right? So you're actually bringing money in when you're selling that protection. So let's explore what that actually looks like. So you click the button and we'll give you a little bit of explanation on how this actually works. It will tell you that you're buying the long call, but then you're offsetting that with a short, right? And what it actually looks like. So at the end of the day, when you execute the strategy, this is what your standard collar is going to look like, right? This is your standard protection. But when you do it with a vertical spread, this is actually what it looks like. You're buying protection, but you're actually getting paid. Like your P&L is positive, people, like by $128. You keep your shares, you're protecting your value of your assets, and you're making money all at the same time. Like this is how the top 1% protects their capital and makes their money grow for them, right? They don't work for their money, they make their money work for them. And this is exactly how to do it. Here's what your drawdown scenarios looks like. Your stock loss, yes, it's going to be the same stock loss that you'll have whether you have a protective put or whether you don't, right? You're going to lose money when the stock price comes down, right? And that's the fear of most retail investors when they just buy and hold, right? Oh, the stock market is down by, I don't know, 20% this month and your portfolio just went to the dogs, right? Went to the crapper. If your drawdown was 10%, you'd lose $2,500, right? On this specific position, on this specific equity. But now look what happens when you actually buy protection against them. You actually have a positive net P&L of $310, right? And it doesn't matter how much the stock's going to fall. It can fall 5%, it can fall 10%, it can fall 15%, it can fall 30%, right? It doesn't actually matter because you have that protection for a 3-month period. So I wanted to create this video because we're at that point where we are at all-time highs, right? There are going to be some pullbacks and we can actually, take advantage of the pullbacks actually happening within the market. But so many retail traders doesn't actually know, really how to hedge their portfolio. So I thought I'd put this out. We have the tools available. Come and visit us at Mindshift Theory. Take a look at the Wealth Grid application. And, like and share this video with somebody that you think might actually find content like this valuable, and somebody that actually needs to protect their equity, right? Somebody that might have got a very different message on how they can protect their equity and how expensive it is going to be. No, it's not. You can protect your equity and still make money all at the same time. It's entirely possible. So like and subscribe and come and visit us at Mindshift Theory. We also have a community called the Wealth Circle community, which is completely free, and we would love to see you there. So until next time, I'll see you in our next video.